afternoon, everyone, and thanks for joining us. I'd like to welcome you to the Monday Minute Live Chat hosted by the Canadian Leadership Congress. And our topic today is about what to expect in 2021, both the risks and the opportunities. And here to help us navigate this topic is Johanna Kyrklund, who's Chief Investment Officer with Schroders. So welcome, Johanna.
Thank you, Caroline.
It's been a while since we spoke, and I'm really looking forward to our conversation today. I know we're all glad to see the end of 2020, but for asset managers, equity market performance was actually pretty stellar in the last year, at least in the second half. So going forward, are global equities going to continue on a tear? What are your thoughts on that?
Well, I think for the time being, the only way is still equity, because actually, if we look under the surface of what performed last year, the outperformance of equities was driven predominantly still by the COVID winners, stocks like Facebook and Amazon. And actually, if you look under the surface, the shutdown sectors still have quite a bit of way to come back. So I think there's more opportunity there to generate return as we start to think ahead to a post-COVID normalization. I mean, obviously, I'm sat here in London where we have, a variant of the virus now. We're in full lockdown. But ultimately, the vaccines are important because they point to some kind of improvement in the situation on a 6 to 12 month view. Generally, I think that there is more opportunity for recovery, more opportunity for cyclicals to do well. And yes, I think if you're looking for return, equities to some extent are the only game in town, because clearly a lot of juice has been squeezed out of credit already.
Right. Now, look, to say that last year was transformative is probably an understatement. Has 2020 changed how you work or how you approach your job?
Well, I think the biggest surprise to me, I was very concerned about how we'd keep the investment debate going when we're remote. And actually that part, the investment work, has actually worked quite well with a combination of remote working and some office work. And in fact, at Schroders, we've come to the conclusion that we're going to commit to flexible working forevermore beyond COVID, because we found that flexibility does reinvigorate us. And I think we used to have a situation where we did all our work in the office, and when we needed to build relationships, we used to have offsites. And I think in some sense, we're doing it the other way around now, where there's quite a bit of work that actually is done quite well at home, provided you can get some peace and quiet, which is always sometimes a challenge. I know for me, certainly with kids, it is. But assuming you can do that, you can get quite a lot of work done at home as well. And then you go to the office to build the relationships and ensure that the team morale is there. So we envisage in the future a significant combination of working from home and also coming into the office.
Great. So right now, there are a lot of risks looming ahead, some known and some unknown. We've had a lot of surprises even in the last few days. In your view, what are the top 3 investment risks keeping you up at night? And importantly, how are you addressing them?
Well, I think number one, obviously, the virus still has the potential to upset our growth expectations. Our central scenario is that the vaccines are going to help. But for example, we've had a variant here in the UK that we weren't expecting. So that still is probably the biggest risk out there in terms of the growth outlook. And what does that mean? It means that although bonds don't seem to offer much value, as yields sell off, I think there is still quite a lot of latent demand for some duration in portfolios to protect against that potential growth risk. So I'd say that's risk number one. Risk number two, certainly a few days ago, I might have said the biggest risk was a premature withdrawal of stimulus. But actually, we obviously had the outcome in the US, which supports further fiscal stimulus. And I think it really comes down to what the work we're doing now is looking across all the countries around the world and thinking, I think there's the willingness to spend. The consensus is obviously it's nobody's fault that they have COVID. And so for once, there's a consensus that people need to be supported. But there might be some economies that don't get allowed to raise their debt levels by the market, that will face a credibility challenge. And that's something that we're starting to think about. A potential risk, I think, more for the back end of 2021 going into 2022. And lastly, one risk I'm not worried about at all, but is discussed a lot, is inflation. I think that to the extent we see a pickup in inflation, and so far we're certainly, our stock pickers are reporting an increase in industrial prices. There are some sort of supply disruptions there. But ultimately, I think to the extent that we get inflation coming through, I think that would be great news, because it would suggest that actually we have the potential for a normal cycle here. It would probably prompt a lot of rotation, but there are lots of ways of making money out of a more inflationary regime. I'm probably more worried if we get weaker growth and deflation, because the deflation hedges are expensive.
Yeah, let's dig into that topic of growth a little bit. Going forward, I think there's a general consensus we'll be going back to the same low return and low growth environment when all this is done. What should investors be doing about it? And do you have any coping strategies that you want to share?
Well, I think the first coping strategy is to some extent one of acceptance. I think that for many years we benefited from a positive carry hedges, namely cash for once upon a time, and bonds, that also had a very stable correlation in the sense that you knew that if equities went down, typically both those assets would do well. And I think we've been mourning the loss of those positive carry hedges with stable correlations. I think the reality is that we don't really have anything that can replace that in our portfolios. Yes, you can use currency to manage risk. Gold can be interesting in some circumstances, but ultimately we don't have that ballast in the portfolio in the same way anymore. So what do we do? Well, I think you have to divide investors into two main groups. There's some investors, which is predominantly a European problem, but maybe also pertinent in Canada, who are being forced up the risk curve because with the suppression of yields, they're not getting the kind of returns they used to get from their low risk investments. And I think for them, it's to move more into opportunistic credit, for example, but also on the equity side, thinking about exposures not in benchmark space, but looking for the highest probability of a positive outcome, which can be achieved, for example, by having exposure to quality equities, maybe with call overwriting over the top. A few ideas there. For those who require growth, I think the challenge is you have to run more concentrated exposures. Thematic opportunities, I think, are interesting. There is a lot of disruption out there. One thing that this crisis has done is hasten the move towards clean energy, for example. So thematics, I think, is a way of juicing up your portfolio and trying to fight the fact that overall global growth is going to be potentially still quite stagnant.
Yeah, let's dig into that topic of growth a little bit more. I was talking to a plan sponsor the other day who was bemoaning the fact that that growth is hard to achieve, and wondering how to approach equity markets in that context and balance sort of the risk in taking on more equities with the risk in perhaps not being exposed to more growth on that side. And how do you kind of reconcile that balance between sort of risk and the growth needed in these equity markets right now, which can be quite volatile?
It's actually an area we're doing a lot of work on now, because I think if you don't have that offsetting effect of bonds, which ultimately offer the hedge against growth risk, which is the main problem you have with equities. And yes, you can go into other asset classes like liquid credit, but ultimately all of those other asset classes are still exposed to that fundamental growth risk when things really go wrong. So I think with the knowledge that you don't have that sort of same offset from bonds, you do need to think about how you construct your equity portfolio more carefully. And I think that on the one hand, you can't take quite as much risk. So I think that you need to have an allocation within equities that is, in some sense, you need to build that barbell. The barbell we used to have between equities and bonds has to be built within equities. So on the one hand, you sort of build yourself a fairly safe equity portfolio, accepting that it might underperform the overall index, but ultimately just focus on that total return, the highest probability of a positive return, and then have the barbell of the thematic strategies to deliver that stronger growth. I think we can't afford to just sit in sort of more index-oriented strategies anymore.
Oh, that's really interesting. So on the thematic side, you've referenced that a couple of times. It's a really interesting area. What are some of the themes that get you excited right now in the thematic space?
I mean, energy transition is a very obvious one. And, it's been interesting that actually Europe, for once, has sort of got its act together a little bit on this particular theme. So as you know, with the Recovery Fund, I focus very much on clean energy. And we still think, although that theme has already done very well, there's still quite a lot to go there. So I think that's an interesting theme. I think the other one is still disruption. And ultimately, beyond COVID, why might we still be facing a low growth environment is because ultimately traditional industry is being disrupted. And again, even in this crisis, automation, for example, has been accelerated. Obviously, machines don't get COVID. And so again, sort of technological disruption in industry is another thing that we've been looking at and that we're exploiting. Sustainable food and water, which is interesting because that gives you an exposure that maybe is less growth oriented. The challenge with some of these themes is they all have a similar style. While if you look at sustainable food and water, that's something that could potentially have a different factor exposure. And digital infrastructure is another one that potentially stylistically is less growth exposed, because the challenge is you also have to create some diversification for yourself on the thematic side. But ultimately, this is a world that is still a disrupted world, and that does create opportunities.
I like that idea of it being a disruptor's world. Do the themes in your view change between, say, developed and emerging markets, or like are they fairly consistent globally?
We look at them with a global lens, so we look across the world. But I will say that what's interesting about certainly China through this crisis is that, actually, if you look globally, the index that looks most like the S&P now is the MSCI Emerging Markets Index, in the sense that it has the same level of similar levels of concentration in tech names that the S&P has, which I think would have been unimaginable even 5 years ago. And I think that one thing that's interesting is also how, in some sense, China's coming up with its own answers to disruption. So it's not just a story for the US, it's actually something that in many cases, so I think Europe is trying to find its own answers in terms of environmental issues. And actually China is obviously in a race for technological supremacy with the US. But what that means is that you can get these disruptive trends interpreted differently around the world, which again is a source of opportunity. So we tend to take a global approach to all of these.
Yeah. So a couple of years ago, as you know, we had the pleasure of speaking together in Montreal at our inaugural Challenge of Change Forum. And you had a great point that really resonated for me about resilience being a team game. Based on the market environment we find ourselves in now, and the fact that our teams aren't together for the most part, how are you working with your teams to ensure they remain strong and resilient? Because I know that's a challenge a lot of the pension leaders listening today are experiencing.
I mean, as Group CIO, the first thing I had to do very quickly in March was set up channels of communication. So the thing I was most concerned about in terms of creating that resilient team was particularly the sort of younger members of the team that typically would be sitting next to senior firm managers and really learning on the job, missing out on those sort of impromptu conversations around the desk. So that was what I was most worried about in terms of undermining the resilience of the team, because for a resilient team, you need to have a very strong bench underneath you. And so I'm thinking about where will our teams be 5 years out if some of our guys miss out on critical learning opportunities. So the benefit of remote working, and this is where you can exploit the benefits, is that, for example, I'll give you a simple example. We had a weekly meeting in our multi-asset group where we would discuss economic trends, bringing in experts from around the company. We had that every Monday at 9 o'clock, and we've had that for 15 years. But we had a meeting room that could take maybe 20 people. So we didn't invite other people because there was no space in the meeting room. I mean, this sounds so odd now, but suddenly we're able to open that up to the whole company. And we now have 200 people calling into that meeting every day every Monday. And so suddenly, not only was I able to help the younger members of my team, but actually reach out to some of our up and coming talent across the whole organization. So this is where you exploit the benefit. You can actually be more inclusive when you're working remotely. And then the other thing, unfortunately, is still person to person, a lot of time spent still chewing the fat, talking about your personal life with various people to still make sure you have that personal relationship, which comes back to another point about resilience, that as the leader of the team, you also have to look after yourself. And again, one of the benefits of this environment is made it easier to some extent to get senior people from across the industry together to talk quite quickly. Once upon a time, to organize something like this, I probably would have been flying to Canada. Actually, we're able to pull this together quite quickly. So those are some examples of the kind of things we've done. Some things have actually worked better with this remote working.
So you and I have had interesting conversations about governance in the past, and I wonder, how has the distance and remote conversation affected governance conversations and trustee concerns in a way perhaps that these conversations didn't go in the past?
You mean in terms of ensuring that we're able to provide appropriate oversight to all our investments?
Oversight, and also just generally with trustees and your board.
Yeah. I mean, again, you know, funnily enough, because we're not traveling, we've been able to make our investors much more accessible. You know, in some sense, it's made everything a lot more informal. And so actually, we've been able to increase the amount of interaction that that our fund managers have with their investors. We've been much more accessible as fund managers. That has helped things. And I think, again, you know, right at the beginning of the crisis in March, I was sort of doing a broadcast for our clients and also for our people. And my top tip was communicate, whether it means calling your mum at the end of the day to make sure she's okay in lockdown, but also thinking, is there a member of my team I haven't spoken to for a while that I need to pick up the phone to? Or is there a client I haven't spoken to for a while that might need a hand? And so in some sense, we've been in communication overdrive, utilizing technology to do that. That has to be the answer. We can't disappear. We have to be visible to the people who've entrusted us with their money.
Yeah, great. Well, look, let's end on a high note. And I'd love it if you could share with us your favorite couple of opportunities that have opened up for the year ahead.
Well, firstly, from a country perspective, there's two markets I've hated for a really long time, Japan and the UK. And actually, I like them now for the first time in a very long time. The reason why I like both of these markets have high exposure to cyclical sectors, which has actually been one of their challenges in this low growth environment that we've been in for the last decade. So in that sense, they become interesting again. In the case of Japan, a high exposure to industrial cyclicals, and in particular, exposure to Asia, where while it's easy to get depressed sitting here in the UK, actually in China, in many ways, things have gone back to normal. And we've seen evidence of a very strong industrial recovery in Asia. So Japan is very exposed to that. It's very correlated with the yen. Typically, it suffers when the yen strengthens. The yen tends to strengthen when growth is weak. But I think we have a window here where we're sort of recovering from the extremes of COVID, where actually the yen could be a bit weaker. So I like Japan. And the UK, of course, has been dogged. I think we were discussing it. The result had just happened last time I saw you in Canada, where we voted for Brexit. And there's incredulity in Canada, which, to be honest, I shared. But you know what? What's done is done. At least we've kind of come to a resolution of this issue. We might not be happy with the outcome, but at least some of the tail risks, like a no-deal Brexit, are now behind us. The UK market looks cheap. Sterling is still quite competitive, and again, some cyclical exposures. So those two markets, I think, are interesting. And then in the US, I think financials and states look interesting because I think you could see a bit of a steepening of the yield curve. So generally, what I'm talking about are more cyclical exposures than I've liked for a very long time, a window of opportunity to exploit those over the next year.
Well, that's interesting. We haven't spent a lot of time talking about Japan or the UK in super positive terms in a while.
Yeah.
So I really appreciate those comments, and I appreciate your sharing your insights here today, Johanna. I'm sure everyone that's tuned in today will find them helpful. That wraps this week's Monday Minute. Thank you all for joining us, and see you next time. Thanks again, Johanna.
Thank you, Caroline.